The whole thing is right? If San Francisco is the Yankees, we're the Oakland A's, and we need to play Moneyball and start trying to just get on base repeatedly so we can actually start making the playoffs.
There's a misconception that supporting the funders of the entrepreneurs is supporting rich people. Supporting the funders of entrepreneurs is what's helping the entrepreneurs to stay in Canada, build in Canada, and scale Canada.
As we know, in order to harness the power of the full population, we need the participation of the full population. And that means women, that means non-binary founders, that means Black, Indigenous, and people of color.
Thank you all for joining us. We have a very exciting set of panelists here, and so I am pleased to introduce each of them for those of you who are less familiar with them. So let's start from left, right? Yeah. So we have Caroline von Hirschberg, co-CEO of Spring, which works at the intersection of impact entrepreneurship and early stage capital. Her career spans 4 continents and multiple sectors, including corporate leadership in the United Kingdom, international development with UNICEF in Laos, and co-founding a renewable energy venture that designed and launched off-grid solutions internationally. At Spring, she has helped mobilize more than $130 million in early-stage capital for Canadian ventures tackling people and planetary health, with a focus on founders from underrepresented communities. And Caroline also serves as chair of Propel Impact, a national organization training youth as the impact investors and leaders of tomorrow through experiential learning and place-based funds across the country. Yeah, let's give it up for Caroline. Now, I think many of you are probably very familiar with our next panelist. She is the amazing Suzanne Grant, Executive Director of Capital Angel Network. So if you don't know her, Suzanne Grant leads the Capital Angel Network, which has built into the #1 angel group in Canada by deal volume. Her career began as an engineering officer in the Canadian Air Force and Army. Curiosity about human behavior, though, later pulled her into entrepreneurship. Mid-career, she moved her family to Qatar, where she launched a strategic communication agency, advising clients including Virgin Health Bank, Samsung, Accenture, and tennis icon Serena Williams. She has some good stories about that, by the way. After returning to Canada, she co-founded a brain-machine interface medical technology startup and has done business in 17 countries, directly closing $25 million in deals and $5 million in non-dilutive and equity investments. Before Cannes, she was CEO of the Canadian Advanced Technology Alliance, and at Cannes, she created Cannes Labs, a national virtual investor readiness program, and has led organizations through its highest development years on record. And also, we're going to just tease it a bit. There's something else that Cannes doing soon called Mashup. So you'll hear a bit more about that in a little minute. And last but not least, at the very end here, we have Jesse Wiebe. He's the founder and executive director of the Canadian Startup Capital Association. Jesse is one of Canada's most active angel investors and a recognized voice in early stage capital. He grew up on a Saskatchewan farm, holds an honors degree in economics from York University, and has a background spanning chemical engineering and hospitality management. In 2021, he founded We Grow Capital and Consulting alongside his father Doyle Wiebe, and has since invested in over 40 startups and multiple venture capital funds. The same year, he launched Startup TNT in Saskatchewan, and the organization, going on to lead its national expansion and agri-food programming. During his 5 years at Startup TNT, the organization deployed more than $21 million into nearly 130 pre-seed Canadian companies. Most recently, he announced that he is leaving Startup TNT to launch the Canadian Startup Capital Association, a new nonprofit coalition representing more than 3,500 early stage investors across 19 plus angel syndicates and small fund managers. Give it up for Jesse. Okay, that was a lot of reading. I'm glad you stuck through it. So what are we talking about today? Amongst many things that have been discussed across the city at many events, including the NACO Summit, is what's broken in Canada's startup ecosystem. So obviously what we're trying to get at here is how can we improve these things? But let's start by giving all of our panelists a chance to maybe push back on the framing. So, Caroline, you said something that stuck with me earlier, that it's not broken, it was never connected. So, please, if you can expand on that, and I'll give each of you the opportunity to please continue.
First of all, a huge thank you for coming this evening. And I also recognize that many of you are experts and living and breathing this topic yourself. So looking forward to the questions and commentary as part of this conversation. Sorry, Daryl. As soon as you said the question, we were like, so let's unpack that question. And can we also just recognize what is working? And so, coming from Spring Lens, supporting early stage founders on their capital readiness journey, to find right fit capital. So for us, that also means what type of capital is right for them. Is it dilutive? Is it non-dilutive? And when does that fit into their journey? As well as values-aligned funders, which include angel investors. So I think from that experience and lens, what is working? One is really intentional inclusive design. So as we know, in order to harness the power of the full population, we need the participation of the full population. And that means women, that means non-binary founders, that means Black, Indigenous, and people of color. And so at Spring, we're proud that through collaboration and connections with partners, we support over 68% of underrepresented and underestimated founders through our work. Another thing that is working is taking a journey mindset. So we have designed programs that meet founders where they're at on that journey. Again, recognizing that not everybody is going to make it with that particular venture or is going to make it with venture capital. So how do we steer them onto their path for success? It's about meeting them where they're at and then taking that journey mindset and tapping into the expertise of the community. So as I'm sure you all are, we're working on very few dollars, trying to make it go as far as possible. And yet we realized that we were trying to do it all as an organization, whereas there is so much expertise in this ecosystem. And so now, in fact, with experts like Suzanne as a facilitator, we now leverage the power of our collective minds across Canada to support founders on that journey. So lots more I can say about that, but those are just a couple of ways in which we are trying to take a more collaborative and connected approach across the ecosystem to support founders at the early stage.
Hi, everybody. Caroline's so amazing. So are you, Daryl. So what is working, what isn't working? First of all, and first and foremost, founders are working. Let's give it up for the founders in the room. I've been at Capital Angel Network for 5 years, and anybody else? Anybody from Capital Angel Network here? All right. So we have seen an incredible elevation of the sophistication of the founders that come to us looking for capital. So founders, you are killing it. Okay, so we see that. That's amazing. We're seeing in our group a real change in diversifying of what we invest in. So we invested in chocolate recently, which isn't something that we usually invest in. So we're just seeing a broader sort of appetite, be it clean tech, life sciences, enterprise software. We're really expanding that. The other thing that I have to say is the people in the ecosystem that are the glue and work together with very little resources to make it work. The passion of the people behind the entrepreneurs, the surrounding tissue of the entrepreneurs, absolutely working. What I see at Capital Angel Network and other places is the willingness to put up a hand and connect to market. One of the challenges, I think, if it's not too soon to go into that, is that we see the Buy Canada is a nice slogan, but we're not seeing it translating into technology, and we're seeing technology maybe as a little bit of an afterthought in some of these big announcements that we hear about the direction, the future of our country. We need to be at the table, the decision-making tables and the advisory tables for where the country is going. We are an engine for growth, and we really need to be there. I do think also, obviously, I think amongst our community. We just came from a meeting, and this is something that in my close circles we've been discussing for about 4 years. When we talk about angel investing, you know, those are the first checks that help to get founders off the ground and sustain themselves until they're ready for VC when they're in that otherwise valley of death. And it is kind of sparse out there. There's not enough capital. It's really tough. And there's a misconception that supporting the funders of the entrepreneurs is supporting rich people, when the actual fact is that supporting the funders of entrepreneurs is what's helping the entrepreneurs to stay in Canada, build in Canada, and scale Canada. So we ourselves have a lot of work to do to change those narratives, and it's up to every single one of us, entrepreneurs and angels and VCs, to make sure when we talk to the community that we let them know that this is for the entrepreneurs. Very often our members tell me, you know, if I was only in investing to make money, maybe I'd put it somewhere else because there's so much risk there. Most of our angels are wanting to invest aligned with their values. So that's just a few things. I'm sure Jesse's got more.
Thank you. Lots to build on there. So as Daryl mentioned, in 2021, I proposed to my father, who was an OG founder in Canada. Kind of a little fun fact here, being here in Ottawa, he was a part of the founding team that sold the first software company ever to the federal government. The Governor General actually had to sign off on the deal. It's known today as FCC's Ag Expert, farm accounting software. Started on a floppy disk in 1980. By the way, there was not a single accountant on the founding team, and it's a farm accounting software. So anyway, that's a fun story we can talk about over drinks after. But one of the things that we decided to do was essentially create a family office, but we didn't even know that's what it was called. And shortly after, I was connected through a former colleague with the group out of Edmonton, Zach Storms and Tim Lin, who started Startup TNT. And at the time, they had identified, and we've really crystallized it, that the key issue, one of the key issues, I should say there's many issues in Canada around this space, is that there's this myth that not only you're supporting these angel groups and stuff, you're supporting rich people, but that if you just build the great companies, the money will just move on its own, right? Like, that's all you have to do. Well, one of the unfortunate realities in Canada is that the majority of the wealth here has not been made in this arena, so they don't understand it at all. They've made their money in real estate and in industry, in more traditional business. And so they don't understand it. And in addition to that, for those that don't know what accredited investor means, basically the government has dictated that unless you're rich, you're not allowed to invest in startups. And that's a whole other conversation that we can have about whether or not that makes sense. But if you're making over $200K a year or $1 million in net worth, you're allowed to invest in private companies. It's what's known as accredited investor. And the economics of being investing in early stage startups is that you have to, if you're writing it on your own, you're writing a 25 to 50K check, and you're writing 20, 30, 40 of them to take advantage of the power laws. So you're talking about $500,000 to $1 million asset allocation. Well, for most people that are in that accredited investor spectrum, that just means simply economically you can't make the asset allocation to startups to actually do it properly. So at Startup TNT, what they did, and they've run this 51 times, is a cohort-based model where investors put in $5,000 each, and then over an 8-week period, they collaborated as a team to filter through a pool of applicants and pick one at the end that gets the pot. And then the cool part is that the investors can always invest more into the winner or into any company that was around the table across multiple streams that are always operating at the same time. And as Daryl mentioned, that's led to over 21 million plus invested in almost 130 companies now from over 550 investors. And one of the things that really then led from conversations that I was having at Startup TNT and within the ecosystem with partners that we're co-investing with regularly and the other founding members of CSCA was the need for this basically on a full larger scale. That our biggest problem in Canada at the moment is capital activation, right? And when you look at the reports from BDC in particular last year, you look back to the 2010, 2014 vintage, and only the top quartile has actually returned more than a 1x of capital. Derek Hunter at Tech Thursday last week also said he estimates only 10% of Canadian VCs are ever going to hit carry, right? So most people that have invested in this asset class over the last 15 to 20 years haven't seen the ROI, in large part too because we had 2 black swan events. We all slammed into the wall of COVID and AI, which really affected that. But we have an ROI and then also a liquidity problem with the previous LP base. And so if we're going to have the capital we need in Canada for the next generation, which, to your point, there's incredible founders across the entire country. And one of the things we have been pushing on a lot is commercialization of IP, and it's starting to happen. Like the students, both undergrad and graduate, are trying to get out of these great ideas out of the university, but there's no capital on once they get out to meet them to help them grow and scale. And so if we're going to seize the moment, right, both with AI and tech, and also in the macroeconomic political climate of the world, where we're looking at how do we build Canada, how do we buy Canada, how do we invest in Canada, right? We're going to need a coalition across the whole country, a connective tissue to collaborate between not just angel groups, but emerging fund managers, LPs, family offices, venture philanthropic funds, Indigenous investment corps, and hopefully we'll get into that a bit too, underrepresented founder networks, investor networks, right? How do we, and even private debt, I'll talk about that one too. That's like a whole other area that we need to get more in. So really that's what the impetus behind the Canadian Startup Capital Association was, to create that full stack, and to also do it for what we define as startups, which is anything scaling regionally, nationally, globally. So not just tech, not just hyperscale venture capital, but really also the mighty middle that's out there. So I'll leave it there and pass back.
Amazing. Thanks, everyone. So let's just continue to play off of that theme of mobilizing capital to get more funds into the ecosystem, because I think we have seen this problem come out in a number of different ways. We see the Canadian companies are not able to access the capital they need here. They often end up going to the U.S. This is a common theme, to look for capital there. They can find investors more easily there. And so one of the things that it's sort of my passion project is to how do we get more people into the asset class, as you were saying, who may or may not be familiar with startup and venture capital, and how do we activate them? We're going to leave the whole government funding to a side here, but what other policies, ideas can we have? And I think, Suzanne, you had mentioned in our chat about this generational wealth transfer happening right now. People are inheriting significant wealth, and so we need to be able to engage them in new ways. So if you want to get us started on that.
I think the number is like $1 trillion, in the trillions, generational wealth that is just ready to transfer. So this is an amazing opportunity if we think about next generation and how they have got a very strong alignment with acting on their values. What if when this generational transfer of wealth happens, if a percentage of that wealth was actually allocated for early stage investing and supporting founders and entrepreneurs? Amazing, right? And also, what does anybody know about it? So how do we elevate the awareness and the education for those next gen folks who are going to catch that capital when they go to the wealth managers and they're told this mutual fund, this bond, this whatever, and the conversation isn't even on the table about becoming an LP in a VC fund or about becoming an angel investor. How we're able to do that is very much on our minds, and I think collectively it's on our minds. We're under-resourced, so what we need to do, there's a massive gap there, but I think this is a great opportunity for our country, and I believe in Canada, and I believe we have everything that we need. We need to shuffle around some of those deck chairs, so to speak, to connect everything. Who's next?
That's right. Give you the last word on this one. So one thing I'll just say to those in the audience is I'm sure there is some people more in my generation here that do have parents that are quite well off. don't just wait around for them to die to start deploying the capital. That's essentially one of the things I had to get over in my own head. Like, my father and I had a conversation when my grandfather passed away, because he was dealing with the will then, and so we had a conversation about the will that I was going to be receiving. And I honestly started finding myself during COVID, when I had moved home and my life in Toronto had blown up. Another fun story we can tell over drinks later. That, what would I do with that money if I had access to it? And realizing that was really stupid. That instead, why don't I just figure out a living inheritance model where I'm not only able to deploy the capital into the things that I believe in and what I value and what I want to see in my country that I'm going to be living in for the next 50 plus years, and maybe even longer if some of those life-saving things we talked about last night end up coming along. And so we decided, hey, let's do this together. So that first and foremost, that's what I'd say to the people in the room, is just like, have that conversation with your parents and say, hey, like I'm going to live in this country. Like, can we figure out how to deploy some of this capital and maybe take a little bit away from some of the wealth managers and put it towards my friends who are entrepreneurs and innovators and get them going. And then the other piece is that we have to find ways to find some alignment with the wealth managers, right? And I've been doing some research lately on a model out of the UK called venture capital trusts, where you can actually put money essentially in a fund of funds on the public stock exchange, and then there is a fee attached, so the wealth managers still get their fee, so they're aligned, and there's incentives there. Because at the moment, there's actually a disincentive, right? The wealth managers get it based on AUM, and so not only do they not want to encourage you because that's not going to be on me, but they're actually losing fees if they allow the capital to move out of their management, right? So there's that, and then there's two other policies that I would like to see happen too, to kind of fix this, in particular from government. We just talked about this in a meeting we just had. One I'm calling the first check exemption. There's also another program out of the UK, and we're going to actually end up talking about the UK a lot, because Kyle Briggs has done some great research on that too. But the UK has a program called SEIS, S-E-I-S. It includes three components. One is an income tax credit that I don't think we can get done with the deficit spending that we're doing in Canada. But the other two I really like. One is it's only on the first £250,000. In Canada, we should do like 500 to $1 million. And SAFE should be eligible and LP should be eligible. So it's like an equity raise. But you take no capital gains tax on exit. Meaning if you invest $100,000 as one of the first checks in a startup and it turns into $10 million, you keep all of it, right? And if we had that in Canada, I think that would send a dramatic signal into the market that it matters that you're writing that first check. And that also would create an urgency. So it's like, oh, I got to get in early, or I'm going to lose this like 10 to 20%, 30% lift that could come down the roads by not having that cap gains tax. And then finally, so that's, ROI is one of the key issues, right, that we talked about, and then liquidity. And with some of the money with Vicky and the other money that's coming out of the government, and even in provincial envelopes, this idea actually came from Tim Lin, the co-founder of TNT, with the AEC money that's now deploying directly into startups in Alberta, that instead of just cramming down the early investors, why don't we buy them out and create liquidity at a discount to the Series B round? But you could create that liquidity in the market so that I, as an angel, who's much better now than I was 5 years ago, I just don't have as much money to deploy. And now there's even better startups now than there was 5 years ago. And I'm like, man, I really wish I had that capital available. Well, if some of my companies are quite successful on paper, but I don't actually get to feel the wins. And that's one of the problems in the overall market right now, is that all the wins are on paper. We need to start getting them realized so that more people will be encouraged to get back into the asset class and the flywheel will start to turn. Anyway, so that's my ideas, and I love Caroline's ideas.
Thank you. So back to the transfer of wealth, and how do we capture that? How do we make sure that doesn't just go sitting in a family office doing nothing and benefiting no one? And so some of the ways that Spring has been doing it, and others, Startup TNT, others in the ecosystem, Sheboot, has been actually thinking about, well, how do we activate new angels and activate a more diverse community of angels? So really thinking about, okay, let's build a values-aligned community of more women investors, of youth investors. And in doing so, also change the pattern of who gets invested in. So it's not just the same old players, but we're actually making sure that we're disrupting old pattern matching and actually getting more money in the hands of more diverse founders and leadership teams who we know outperform. We know they're more likely to export. And so I think one interesting dynamic there, and especially Spring is focused on impact, and so we attract those who are either new, and whether that's transfer of wealth to women or to younger generations, are thinking about investing with values in mind, investing in future generations as well. And so what resonates with them is that beyond revenue and growth and profit, of course, these companies, these entrepreneurs are also thinking about the health of people and planet. And so that's really the core of our thesis and who we're attracting and the capital that we're attracting. Another thing I'll share, and it's absolute plug for Propel Impact. If you don't know them, they're doing incredible work. But Daryl, you mentioned they're training the youth of tomorrow. And so it's also about whether or not they have capital today, but they are being trained at university through experiential learning of what does it look like to analyze a deal? What does it look like to be the investment committee and advise on how capital is deployed? And they are going to be the social purpose leaders of tomorrow, the impact investors of tomorrow, but also making sure that we aren't just rushing to immediate outcomes, which I think a lot of the budget focus and industry focus at the moment is on. It's on immediate job growth and creation. And I think that where what I'm emphasizing is let's ensure we remember the pipeline, and that we are also investing in the superstars of 3 years' time as well, in where the funding goes. And I think, and final point, and then I'll hand it back to you, but a lot of these models exist, actually. And so, for example, I was doing the maths on some of Spring programming, so, and I'm sure many of yours are the same, $1 of public funding translates into $36 of private capital catalyzed. And so that's great. We've proven models that can work, but we need funding to scale them because, and this is where we will get into government funding, I suppose, because, it's on the list. So we have some formulas that work, and we know that they can scale. The challenge is right now we are supporting the early stage ecosystem as charities, effectively. You know, a lot of us are doing this work unpaid, off the side of our desk, stretching budgets way too thin. And the reality is that investing in this early stage is going to have such a ripple effect. And especially on impact-driven businesses. The knock-on effect on people and planet is frankly the change that we need to be investing our capital into.
Well, thank you all for that. You know, I particularly like to emphasize on the education part, teaching our next generation on how to look at this. I've had the benefit to go through programs that have taught me about the venture capital space as well, and I think it's really important that we learn from people who have had positive experiences in the world of startups and take lessons from those so that we can apply them going forward. Caroline, one of the things that you had mentioned in our prep was that we keep force-fitting some founders into equity when that's not necessarily the right journey as well. So I think if we look at the startup ecosystem as a whole, not everyone needs venture capital money. There are a variety of other options: venture philanthropy, working capital, lending. I think Jesse had mentioned futurepreneur. So is it less to say that parts of the ecosystem are broken and maybe it's more of a matchmaking problem? I think you touched on that before. Maybe you can just expand a little bit on that.
Yeah. Happy to. And again, I'm conscious I'm probably speaking to people who know this inside out. But I think one thing that we've been, as I said, working to do is really help founders navigate that capital stack. And venture might be right for them later, but it also may not be the path that they actually want to go down. So it's about equipping them so that we all have the success rates we want to see, and so that we aren't frankly putting our capital in the wrong direction. So it benefits all. Some of the fun things, if you like to geek out on this sort of thing, that Spring has been doing just off its balance sheet is trying out different modes of funding. So obviously you have fantastic entities, the WeBCs of the world for women entrepreneurs, Futurepreneur for youth, and so kind of very classic loans. But we've come across situations where the founders are in that kind of bridge round stage. They have some orders on their books, but what they're up against is some really high interest rates on the loans being offered on the market. And so we've just played around with, if you like. So how do we offer, say, a convertible note where a loan where actually the interest on that loan turns into equity once they repay? Or revenue-based financing. I mean, Spring ourselves, we were funded originally by investors at one point, and then we were able to buy them back as well. So also making sure that founders understand their full, exciting range of tools that they have at their disposal is a core part, I think, of the conversation we need to be having, and connect, again, that kind of connective tissue across the ecosystem of making sure that we have those lines of communication open so we can flow founders to the right capital at the right time. Want to say anything anymore? No?
Yeah. So I mentioned, I think, a little bit like the idea of like the mighty middle, which I first heard from Bryce Shashuk, who actually gave the very first iteration of his keynote presentation, Founders Play Your Game, which is fantastic. And if you haven't ever watched it, it's on the Mindframe Connect website. You can find it, and you should watch it. That the idea that you can create scalable businesses, and again, we define startups both at CSEA and at Startup TNT as any company looking to scale regionally, nationally, globally, right? Not everything has to be Shopify. Not everything has to be Google, right? You can build a great business. You can build value for both yourself and for your investors by getting a $25, $50, $100 million outcome. And part of the key piece here is that you need to be understanding where that entry valuation needs to be because of where you're going to exit. So one of the advice to folks in the room, because I'm sure there's a number of founders in here, if you want to build more of a mighty middle company, be realistic about the valuation you want at your first stage, right? I've had founders pitch me time and time again that are essentially building a mighty middle company, but they want a $10 million valuation. It's like, no, you got to start at like 2.5. Because otherwise, then, in order to get out, you got to get it all the way to 100. And one of the great things that's happening on the other side is like there are more and more investors in Canada that understand this, right? That are understanding that the Canadian model needs to be different than the San Francisco model, right? If San Francisco is the Yankees, we're the Oakland A's, and we need to play Moneyball and start trying to just get on base repeatedly so we can actually start making the playoffs. Because at the end of the day, right, we're that far behind, and we're very different than SF, right? And that's not to say you can't hit a home run to keep the win streak alive, right? But you can get a lot more going if you start to think about more scalable outcomes, right? That create an opportunity where a founder and a number of investors make good money, right? And then are able to recycle it back into the ecosystem and continue growing the overall capital pool that's available for maybe those startups that are looking to build that moonshot company. So that's one of the key things that we're thinking about at CSCA, and one of the key reasons why we didn't have anything around venture capital in our name is because we need to be thinking about other kinds of opportunities. And one other thing I'll say too, when it comes to alternative forms of capital and things, and what we maybe need to fix, say on the debt side in particular, is that we need to start educating our banks and our lenders on safes. I think in particular, right? And one of the unfortunate realities of international accounting standards is that safes live as liabilities on the balance sheet when they're not, like they're equity. Like you don't have to pay it back. Like convertible notes, on the other hand, yes. But safes are effectively equity, and so I've talked to some accountants about this. Like we're probably not going to change international accounting standards, but if we can help the bank lenders at these small business branches and things like that understand, I raised $1 million on safes. I have $1 million of equity. You can lend on that, right, and help me grow with that additional working capital. We have a great company called VGain out of Vancouver they've done exactly that, raised $1 million. A lot of it actually through Front Funders. Shout out. Another great organization getting alternative forms of raising capital into the market. And the bank and FCC and others won't lend on that, right? And they don't understand it. Like, wait, like you're not a profitable business, and it's like you can kind of only be one or the other at a time, like growing hyperscale growth or profitable, right? And so if we're pushing people to say, hey, be ambitious, think big in this country, and then meanwhile all of our lending institutions are like, wait, why aren't you making any money? That doesn't make, like, those two things don't jive, and so we got to figure out a better way to think about it. So yeah, thank you.
Thank you. All right, so let's finally talk about government. We're in a government town. I know you were all on the Hill. Jesse, you said there are a lot of holes in the bucket at early stage. So, pouring more water or more money in this case, when the bucket is leaky, perhaps not the best instinct. We know there's hundreds of millions of dollars on the table in the recent budget, and there's all kinds of ideas as to how it should be deployed and what have you. But even if it isn't deployed, what other policies or what other things should our governments be doing to unbreak the system that we have? Who would like to start?
Okay. Okay, here's the news flash. So I did just go as an observer to a meeting, and the $750 million did come up. But I asked the question, what do you want to see? What's the outcome that you're looking for when this is deployed? What does success look like for you? Because there is immense complexity for a government to try to support their country, their ecosystem, their goals, and get that match. We think about the complexity of finding a fit between the founder and the investor. There's just so many multiples of ways it could go wrong inside of there. So what's really interesting is that they're in listening mode and they're trying to figure it out. So what they're looking for, though, is the people inside the government that are trying to figure out what's the best way to actually deploy and use this capital, is they can hear from a group or this group or another group, and they can make a suggestion. This is at the bureaucrat level. And at the end of the day, at the political level, they have their own ideas, and they're looking for fast wins. And maybe fast wins isn't what serves us Canadians. And so what we can do, what they really need, is amplified the granularity of what life is really like, right? Because they don't know, because it moves so quickly, and we don't do a particularly good job of helping them to understand that. Now I'm going to go kind of away from that, and I'm going to just talk about when we talk about policy, I'm not a policy expert, first of all, but there are policies that can support and amplify and boost, and there's policies that can get in the way. So Buy Canada, what does that really look like? That's one thing. And then there's been some new policies. I spoke to our top investor last night, and I asked him, he's also a founder of a company, or a leader of a company he invested in. And I asked him, and he said there are some regulatory type good meaning policies that just get in the way. So we all, of course, are anti-slavery, but when anti-slavery is actually written into procurement documentations and then you go to a supplier in the U.S., and you ask them to sign up for it, the liability is too high, and they'll just say, go away. So it's just an example of a really well-meaning, something we can all get behind, regulation that gets in the way of supply chain and business. I don't know the full breadth of that, but I still hear, and I've been hearing it for a decade, from some of our founders that just aren't getting the support from home. A competitor from somewhere else wins the deal, and they can't get lift off because if home base is not supporting them, the rest of the world is saying, what's wrong with you? I'm going to pass it to who's next.
And on that chocolate chocolate example of anti-slavery. So if you don't know Tony's Chocolonely, first of all, try it, it's delicious. But they, out of the Netherlands, now they have distribution here. They were all about anti-slavery. And they realized that actually, whilst that was absolutely something they were dedicated about ensuring was not in their supply chain, they realized it was so complex that they now took that off their marketing. They said aiming to be slave-free. So great point in terms of how regulation can sometimes be impossible to achieve. But back to the question at hand. So policy-wise, one thing that I have been in communities, in roundtables on a lot over the past 3 years is we've worked on the women's entrepreneurship strategy. And so there's been a decent amount of funding dedicated towards supporting more women, both in venture capital, raising equity investment, as well as getting more women involved in angel investing. And so I think many of us here will know that there was that has now ended, that program. There was no mention of a women's strategy or dedicated budget towards women. And so whilst maybe several in the room may be thinking, well, there's a lot of work that's already been gone into that, I think we're at a point of a special risk of regression, of losing a lot of the progress that we've made on that front for several reasons. One is because as this focus on job creation and growth and revenue is really front of mind on a lot of the budget KPIs, the risk is it goes later stage and also into defense and clean tech industries, which are notoriously male dominated. And so I think for several reasons, we have a real risk of seeing many women left out of the capital stack and the fundraising process. And same to the board level, and then ultimately the ripple effect of if you can see it to be it. And so the fewer women that we see that are getting funding, that are at the helm or on the boards of these companies, it's just going to have a negative effect in terms of that aspiration. So that's a huge piece of what I and what Spring have been advocating for, which is let's make sure that women are named in the budget, that there's clear money on the table to make sure that we don't go backwards. It can be under a different name, it can be under a different strategy, but it was a real miss. So.
I'm going to say a few things here and correct the record on a bunch of stuff. So the media likes to say all kinds of things and editorialize and make things out to be differently than how they really are. So first and foremost, CSCA was not created to go after a particular envelope of funding from the government or to create a different envelope or to start a fight with any organization. It was created to amplify and help grow the things that are already working in the ecosystem, to activate more private capital and make it more sophisticated, to get those emerging fund managers, LPs, family offices, angel syndicates, private debt, indigenous investment corps, underrepresented investor networks. I'm going to keep saying the whole list because there is so many different types of startup capital. And we need to amplify that. We need to help it grow, help those activities grow. We need to get them more resources, both public and private, from both federal and provincial levels, and even municipal levels. And we need to really help them scale across the country and help them work more collaboratively together. That's what CSCA was created for. And any funding we're advocating for isn't going to flow through CSCA if I can help it. I don't want to take a dime if I can help it. I want it to flow to the ecosystem. I want the founders to end up with the funding at the end of the day. Second, Claudio, Ben, and I are not fighting. We are all advocating for a really critical issue in the ecosystem, right? One of the reasons we're all talking about these issues is because it's across the entire stack, right? Claudio and I have talked about this. Ben and I have talked about this. The whole thing is fucked. Right, I'm using PG-13. That's the one F-bomb we're going to draw maybe for this Tech Thursday. But it is. It's really, really messed up because we haven't spent the time and the attention to build the critical infrastructure across the entire thing, right? And then going to the leaky bucket argument. So one of the reasons why I said that is because the culture in Canada, unfortunately, is still too much first to be second. And that goes back to exactly what you were saying about the procurement thing. We have a company in Regina, shout out Off Street. They're doing incredibly well. They're selling parking for universities, particularly for like events like big basketball tournaments and football and stuff, and they're actually expanding into more parking. They've got UCLA, they've got Stanford, they've got MIT. They can't get the U of S or the U of R in Saskatchewan, which is insane, right? It's like, why do I have to go down there to find my first customer when I've got one in my back door? So there's that kind of cultural problem, one first to be second, but then there's also like so so many fund managers in Canada, and it drives me up the wall because I think it's cowardice, will literally tell me all we do is follow. And I'm like, what do you mean all you do is follow? And I'm an LP in VC funds. If a VC fund tells me that, I'm not going to invest in it because it's like, what's your competitive advantage if all you're going to be is first to be second, right? That's ridiculous. We need to create a culture in Canada where people are willing to place that first bet. And the unfortunate reality, too, with some of the government funding piece, and this was discussed at the Tech Thursday in Calgary, which is also recorded and shared, by the way, we're being recorded, so if people want to listen to this afterwards, this will be great. But the government funding creates these weird, perverse incentives amongst fund managers. In particular, because, as again earlier, Derek Hunter mentioned at that Thursday in Calgary, that most VC funds don't hit what's known as carry, which is a percentage of the profits, right? So it means most VC funds are making their money off of management fees, which is based off of assets under management, or AUM. So that means that these VC funds, more often than not, especially on the first or second fund, and then if they're getting the funding from either federal government through Vicky or through one of the other provincial fund-of-fund programs like AEC, Venture Ontario, Investment Quebec, they have an incentive not to take the high-risk bets that might blow up before the next fund is raised. They need to make sure that the Fund 1 portfolio and the Fund 2 portfolio stay intact, right? So that they can raise Fund 3 from the same group of LPs instead of raising it from the high-risk private investors that would be more incentivized to go for the profit, right? And so that's what you end up with, is you end up with these VC funds in Canada that are coalescing around consensus picks. Matt Roberts and Ben and I talked about this on the Beta Kids podcast, right? They're time and time again, right? We're all like, oh, we're going to invest in the guy that's got the flashy whatever, when we should be investing in the weirdo in the corner that's actually going to do the cool stuff, right? That's when I talk about like the leaky buckets. Like if we don't have that cultural shift, if we don't get better fund managers in Canada that are willing to take risks, it doesn't matter how much money we dump in. It's just going to end up in the same bullshit that got us here. So anyway, there's my rant on that.
Point of view, maybe?
Yeah, well, I've got a little spice here. But I think it's time for some questions from the audience. We got a quick hand right up there, so please come on up. We have the one mic. But I'll be happy to take 2 or 3 questions, and then we have a closing one prepared. That's right? Yes, and let us know who you'd like the question to be asked.
Or all 3. So it could be all 3 or whoever wants to answer it. I was at CIS yesterday, similar panel, similar topic. Lots of talk about funding and all those sorts of things. The topic that was never addressed was salaries. So Canadian salaries have, over the last 3 decades, consistently numerically lower than, say, US salaries. I saw a post just a few weeks ago, exactly the same problem. And a post that I saw in BC, it was an entry-level engineer posted below minimum wage as of June 1st in BC. So outrageous. Ideas on how we fix it.
Who would like to handle?
I got this. Yeah, because I've actually talked about this one a fair bit. When I first got going in Saskatoon with TNT, and talking to some of the founders, I was like, where's all the best developers, right? Because I'm investing in these startups and I want to, find them the best talent. And I said there was this meetup called YXE Devs. You should go to it, right? So I went to it that night. None of them worked for a company in Saskatoon, right? All of them worked through shells into a U.S. company. They had worked at companies in Saskatoon, like Vendasta, Seven's Just Coconut, 3 of our sort of big 3, as we like to call them in Saskatoon, that are much further along. But they decided to move on from those companies in large part because the salary in the U.S. was way better. They could do it through a shell in Canada, and therefore they were getting USD and still able to and pay the Canadian tax rates and get advantage of all that entails. And so what that really started that journey for me. I'm like, wait, why is this a problem? And then you start to hear about it even more from other founders. There's a few things. One, going back to the whole, like, we're not realizing gains at all. One of the ways that you try to balance out salaries with startups is through ESOP programs, right? Through employee share option plans, right? And so I asked some of these devs about this, and they're like, yeah, we're never going to get it, so why do I give a shit? I would rather have the cash flow out of the U.S. than take a stock option that I'm never, ever, ever going to realize, right? It doesn't actually balance out at the end of the day, right? So that's one of the problems. And then the other problem comes back to the whole thing that we're talking about is if these companies are undercapitalized, which they predominantly are, then they can't actually afford to pay the salaries that are competitive. So yeah, you're consistently getting, maybe like the B or C team candidates instead of being able to go after that A team, unless you're lucky enough to convince them for whatever reason, like with passion or, impact with around that particular project, that they should forego earning money now to really focus on the long-term goal. So, I mean, I'm more just like talking about like why the problem exists. I honestly don't know how we solve this one, because it isn't where I think it's got to, yeah, you're absolutely right, like Suzanne's saying, prosperity. Like the only way, I think it comes back to the whole thing. If we need more private capital going to the market so these companies are properly funded for long enough so that they can pay the salaries that those early high talent employees deserve, so they can stay here in Canada and continue to build. Yeah.
Sorry, Julia Alvidge, co-founder of Sheboot. My question, I think, is for Suzanne and Jesse. And you, Suzanne, I think you started to say what success looked like when you talked to the government officials. I didn't understand the full answer. I'd just like to know what does success look like from those government officials, and what are they expecting from us, and who'd you meet with?
We met with Aline Dimitri. She's in ISED, and she's, when we met with her, she's DG ISED, in charge of this $750 million and many, many other things. Vicky is under her portfolio. She also has the BDC mandate, and I met with her with a different group yesterday morning with Victoria Lennox. So we were much more conversational today, and so that question, I asked a question, and I didn't get a clear answer because I think they're even still figuring that out. So ISED is trying to put together the pieces, and what she explained is what's in the budget is exactly kind of what they get, and they have to decipher it through signal that they're getting from the political class, and at the end of the day, the decision will go up, and they're in explore discover mode. Entrepreneurs, when you're not sure how to fill in that white blank of paper, right, and you got all the puzzles you're putting together, you go to customer discovery. So they are doing stakeholder discovery to figure that out. One thing she did say, though, is that they're looking for shorter wins, and that if I get this right, that's why there's a lean to the later stage, is because I think that will get them a shorter win. And our communication at both groups really has been the importance of that early stage and the multipliers. Kyle, I don't know if you want to come up here and share or not, but you got a great data point. Come on up. You got a great data point about, yeah, Kyle.
That's the guest panelist.
2 seconds on the importance of the early stage.
And who you are.
Okay, so yes, I'm Kyle Briggs. I'm a physicist by training, entrepreneur in residence for the University of Ottawa, where I help scientists start companies. And a lot of the work that I've been doing right now is around the interface of research and early stage commercialization. So building tools to streamline tech transfer out of universities and into startups, and then capital mechanisms to get investment into those pre-revenue companies in the valley of death between founding and tech transfer and those first private sector checks. And so the mechanism we've been working on is based on venture philanthropy, this idea of investing dilutive capital in a not-for-profit structure that then recycles those returns back to support, so that the gains from the previous generation support the success of the next generation. And there's compelling evidence from Europe in particular showing that moving capital earlier into the capital stack actually increases the economic uplift resulting from it. And a lot of this is based on a data set of real university spinouts from North America, Europe, Scandinavia, UK, demonstrating that a focused investment in those early stages, in those pre-revenue stages that is recycled, can actually create this self-sustaining mechanism that builds prosperity and builds the ecosystem long term. But it starts at that first stage, that very early stage, where those first steps are taken, and where a lot of IP is lost if we are not supporting founders across that first stage. Right. Yeah. So the evidence, and this is based on studies of European ecosystems, suggests that where in the European version, where public capital was deployed in the capital stack, moving the same amount of capital earlier in the pipeline actually doubled the economic uplift that was created in the long term by the deployment of those funds in the early stage.
Awesome. Yeah. Give it over, Kyle. Talk to him more during the networking at the end. He's got a lot of great data, and definitely check out Can Innovate. His Substack is pretty awesome. So answer your question on this. So Suzanne was observer in this one meeting, but we've had other meetings. It's actually this whole kind of thing for Caroline and I with CSCA kind of originated from a meeting we had with policy advisors to Minister Joly and Minister Champagne. In particular, in that meeting, when we were asked actually to have that meeting with them through our network, they said, hey, we'd love to speak with some people who are doing grassroots work on the ground to activate capital and help get it trained. I had a meeting that they told me, hey, if you can get a group together to come talk to us, we'd love to hear from them. So I did that, and we had in that meeting, they said, hey, we love what you're doing. We want to support it. The unfortunate reality is that, to what Suzanne said, on the political side, the money was originally intended for early growth stage, which in their mind they define as Series B. And I'm not to say whether that's the right choice. And I think Claudia and I would both agree there's a lot more problems in the early stage than there is in the later stage. But it's politics, and what they decide is what they decide. But doesn't mean we shouldn't be shouting and saying that it should come to the early stage. But they did indicate, hey, well, what if you got a slice, what would you do with it? And that's where our proposal that you might have seen in some of our press releases and stuff came from. And then we've continued to have that conversation, because this is a long-term conversation that we aren't going to solve it with a single envelope of capital. It's got to be something that we think about more holistically. For example, this new sovereign wealth fund, right? What if we could carve out a portion of the sovereign wealth fund for early stage funding, right? If we're actually going to build wealth in this country, we should make sure that we're starting it from the beginning, because if the company leaves, then you can't build wealth, right? And that's what's happening. If you've been reading, some of the articles, especially from our friends at BetaKit, they've been talking a lot about that over the last year, is how many young people, and even, shout out Jesse Rogers over in Waterloo. I've talked to him a fair bit about this. He's helping founders build, and after 6 months of them trying to build in Waterloo and finding no capital to allocate to it, they're I'm just going to go down to the valley because people don't want to build here with me, right? And so we got to be thinking about this, more holistically rather than just one government funding envelope. And that's a key piece of the work that Caroline and I have spent the last few days. I know both of us have been getting a bit of a crash course in government relations and how you have to talk about the political side and the bureaucratic side, and how those two sides interact, and what one side can say and what the other side can say. But we're going to continue having these conversations. We're going to continue to work in collaboration with NACO, and we're going to work with the CVCA, and we're going to work with any organization in the country that wants to make sure that there's more funding available for the founders. Because at the end of the day, that's what it really is all about, right? We're not doing this for ourselves. I'm not doing this for me, right? If I wanted to do something to enrich just myself, I would have not have done this, because this is a lot more work and a lot less thankless, generally speaking, than just going out and getting rich, being an investor on Bay Street or something like that. So yeah, that's where we're at. And Caroline, I don't know if you wanted to add anything since you've had some meetings. Okay.
Amazing. Well, I unfortunately, we're short on time, so we're going to wrap things up. But I know these amazing three panelists are going to be in the room for quite some time, so I know if there's a few more questions, they would be more than happy to answer them. So we had a little bit of spice. We had some guest speakers. We had some great Q&A. This is amazing. But we do have one last question. So I would love a short answer from each of you. You spent an hour now talking about what was never connected, what isn't being mobilized, what's not yet built. But for the people in this room, the investors, the founders, the ecosystem builders, what is one sentence on one thing you'd ask? Or sorry, I'm going to reorient myself. For all of you in the room, what is one thing you would ask investors in this room to do tomorrow? What things you want founders to do, and what things you want the ecosystem to do? I am going to go over there. If you want to hit next on my computer. We have a QR code. We'd love you to take a moment, even just right now, to scan that and give us your thoughts about what's broken in the ecosystem. And we'd love to be able to again, speak to this going forward. What areas, from whatever perspective you're in, is facing the greatest challenge when it comes to making our ecosystem thrive? Because basically we want to make sure that that's connection. But again, I'll let everyone take a moment to scan that QR code, give us a message. If you don't happen to be able to do this now, then we'll leave this up and you can come by a little bit later. But one last thing just to wrap things up. What do you feel is possible for founders, investors, and ecosystem players that could be improved?
I'm going to cheat. I'm going to take the ecosystem one first, or I'm going to take that one. There's so much power that comes from having a conversation and from being curious. I wince when I see conversations that start with assumptions. And so what I love is when you're in a room and actually people are asking open questions, wanting to explore and connect the dots. And I think that's just, there's so much power in that for us to see how aligned we are, see how much we can do together. And so I encourage us all to get in the room with each other and ask questions, be curious, and look for ways in which we can collaborate a bit more.
Amazing. Doubling down on that one. I think that's absolutely right. So also, when we're asking those questions and when we're getting answers, and if you're talking to a founder, don't be too quick to dismiss the idea. Look a little bit deeper. Look at the person. Look at their inspiration. Look at the way they connect dots. Look at their potential. And whether or not they're on the wrong track with their startup, take a minute and let them know you see their spark. Because we need more founders staying in Canada, building in Canada, and it is tough. And if they're on the wrong track and they're not going to get funding because they got to pivot, give them the inspiration to just keep doing it. Connectivity, two-way street, always street. Talk to each other. Talk to everybody. Don't pitch them in their face. Just be human. Everybody wants to connect, and there's many ways that you can connect. This is a great environment that you've done. Let's give it up for Tech Thursday.
Absolutely. So yeah, on the investor side, there's a number that we have not been tracking as a country that I think we should be tracking, because I think it would really sum up basically what's actually happening on the ground and whether or not there is the capital available for the ambitious founder starting a company today. And that's net asset allocation, right? How much are you investing out of your net worth into early stage venture, into high risk, high reward, into startups that are looking to scale regionally, nationally, and globally? And that number should be at least 5%. Right, 5% for Canada has kind of become a bit of a phrase I've been throwing around a lot lately, because I'm pretty sure it's a lot less than 1%, because again, we haven't been tracking this number. And everybody in this room, I guarantee, knows at least one accredited investor, one person that has more than $200K a year in income or $1 million in net worth, not including their home. You probably also know some self-certified investors, which is another category in a number of jurisdictions here in Canada. And I was chatting with some folks at OSC today. Then they're working collaboratively with the other security commissions to actually roll that out across the entire country. So you all know somebody who could be allocating that 5% for Canada. Ask them, how much are you allocating? Right? Are you allocating 5% for Canada? Right? And if they're not, ask them why. Right? And help drive them towards the organizations that might help teach them how to allocate that 5% for Canada. Right? If these people said, hey, I want to be more involved in impact investing. I want to make sure that the planet isn't going to burn so I can continue living on it. Maybe I'll put some money in spring, right? If you're here in Ottawa and you want to be investing in some of the best companies from across the country, maybe you join a capital angel network. If you want to invest in a cohort-based model where you're putting in that $5,000 and running through an 8-week process, maybe you're going to invest with Startup TNT, or you're going to invest in any of the other member organizations that are part of CSCA, NACO, CVCA. There's so many places they could be allocating 5% for Canada. Ask them why they're not doing it, and let's start pressuring more people to build this country and invest in this country.
Love it. Love it. I'm all for that. Well, I think we have to call this an end of this portion of the evening, and Lisa's going to, I guess, close us out.
Hi, everybody. I'm Lisa Johns, and I help startups in the health tech, med tech, and life sciences space navigate the regulatory pathways towards commercialization. I'm also the third musketeer out of our Tech Thursday trio between Paul and Daryl and myself. And I want to just give Daryl a huge thank you for moderating this panel. And also thank you to Caroline, to Suzanne, and to Jesse for their candid and very well-informed discussion on a very important topic tonight that I know is near and dear to everybody here. There's a few events coming up that we want to talk about. And first, Suzanne is going to tell us everything she can in 30 seconds about Mashup.
Who here has been to Mashup before? All right, how much fun is it? That's it. That's the reason to come. So another thing about Mashup, so Mashup, we'll have over 50 investors in the room, 150 Elgin. We usually get 100 startups. I'm sorry, the daytime is all sold out, but you can come for happy hour pitch fest. The companies that have been on our stages have gone to do amazing things. I just found out last night from my old colleague Matt that one of the companies that came through CanLabs, a different program we have, is now valued at $240 million. And unfortunately, in Ottawa, we're going to do something special around that. Unfortunately, Matt was the only Canadian that invested in that company. But anyway, so come to Mashup, but there's something very special with Tech Thursday at Mashup. Do you want to talk about it? You're going to talk about it? Okay, so come to Mashup if you want to connect with founders and you want to connect with investors. It's good fun. There's lots of learning. Special guest is the Honorable Janice Suds is going to be coming, and she's now Parliamentary Secretary for Defense, Transformation, Procurement, and also Parliamentary Secretary for Defense Procurement. So we're going to be talking about life sciences, and there's still an opportunity to get a showcase if you want to get yourself in front of investors. We have a tour of the judging panel, and it's the only way to get into the day program. Over to you.
So May is Daryl month at Tech Thursdays. So if you're a Daryl fan, Daryl is going to be moderating a panel at Mashup. And if you don't have your tickets yet, you can use our Tech Thursday code, Mashup2026 TTH, for 20% off. Get your tickets while you still can. On Thursday, June 4th, we are hosting a Hard Tech Founders Dinner. This is an intimate evening of good food and real conversation. No pitch decks, no agenda, just appreciating the people doing hard work. If you think you want an invite, know somebody who should be invited, or if you're interested in sponsoring, please come find one of the three of us after this. And later in June, we are going to be revisiting defense tech for an upcoming panel. So again, if you want to be involved, come and talk to us about it. As always, follow us on LinkedIn and subscribe to our Luma so you'll know what events are coming up and you can stay part of our community. And with that, we will close out the night. Thank you all for being here.